welcome back to the Lance Roberts Show podcast here at realinvestmentadvice.com. We're speaking with Kevin Lenox today, CFA, for Senior Wealth Manager from United Capital. So just for the break, we were talking a little bit about interest rates, the impact on borrowing costs, etc. And when we start combining stronger dollars with interest rates, and particularly looking at the economy and the manufacturing side of the economy, which has a big impact. We're starting to see some deterioration there. One of the things that is interesting is that here we are a decade into an economic expansion. We've got consumer confidence at record highs. We've got sentiment surveys at record highs. Sentiment surveys, how we feel, right? It's not necessarily what we do, it's how we feel. So when we take a look at ISM manufacturing survey, the ISM services survey, these are sentiment surveys. How do you feel about your business? How do you feel about the economy? Oh, I feel great. But that's a little bit different story than when you actually start digging down and looking at the actual activity. Are we starting to see some impact from higher rates and a stronger dollar on the actual kind of manufacturing side of the equation?
It's just starting to happen in the U.S., but the global purchasing manager index on the manufacturing side has been slowing consistently all year. And that is a good tell for global growth down the road, particularly the new orders component.
Right.
So it's the high beta impact on the overall economy, manufacturing versus services, although it's a smaller component of the overall economy.
Right. Well, one thing that's been a big boost here to the U.S. in particular, but also overseas. I mean, and look, we go back to 2015, 2016. We had a very similar kind of action in late 2015. We had a decline. We had a rally, another big decline in early 2016 that as we were worried about Brexit and what was going to happen with the Brexit issue. Then we had the ECB, the Bank of England, Bank of Japan, all come in with their own version of QE to really supplant the lack of QE from the Federal Reserve. And we saw this big boost in late 2016 into 2017. We saw markets rise as that increase in liquidity was coming in the markets. But now all that's beginning to reverse. We're starting to see that extraction of liquidity. And is that liquidity push still positive, or has it started to turn negative?
It's forecasted to turn negative in the beginning of next year, and it is having an impact. So you're right, the European Central Bank stepped in the beginning of 16, quieted the markets. They took the unprecedented step of actually buying corporate bonds for the first time.
Right.
And we had a credit impulse positively that went through the global financial markets. Now, as the European Central Bank is winding down their stimulus at the end of this year, the Fed is in mode of raising interest rates, reducing its balance sheet. Now the markets have to kind of fend for themselves.
Right. When you take a look at the Fed, they're now ramping up their roll-off of their balance sheet up to $50 billion a month. That's a very different backdrop than what we saw over the last decade, where they were injecting capital into the markets on a monthly basis.
Yeah. And I think this just reinforces these late cycle business dynamics that we've been talking about, the higher level of volatility in the market, and just the higher downside risk. This is the fourth slowdown globally that we've had since the Great Recession.
Right.
Does it teeter into something more, or does some new monetary policy stimulus kick in, or another round of fiscal stimulus?
Right.
It's not on the table yet, but we will see.
Well, and I guess the question is also the efficacy of it. One thing that is interesting, when the Federal Reserve stepped in the financial crisis, after the financial crisis in 2009, the Fed balance sheet was about $500 billion. They ran it from $500 billion to $4 trillion. So, the question now becomes, is they've reduced it down to, $3.5 trillion now. Can they double it, quadruple it again to bail out the next financial crisis? Or is there a limit? Since they're actually buying bonds out of the market, there is a limited supply of bonds. Ultimately, at the end of the day, there is a finite supply of bonds. It's not indefinite. Is there enough bonds out there for them to buy to supply enough liquidity to bail out the next financial crisis?
They can until they can't. And there's a risk that market forces step in at some point.
Right.
Over in Europe, the European Central Bank balance sheet now exceeds GDP.
Right.
As we say, it's not a problem until it is.
It's not a problem until it is. One thing we talked about earlier is that we are seeing a decline in the global manufacturing index. And one of the interesting claims that's made is that the U.S. can remain an island relative to the rest of the world in terms of, we look at the rest of the globe, and you take a look at, for instance, your all-world index, less the U.S., it's been in a very major bear market at this point. There is a global slowdown that's occurring, but there's a belief that we can remain an island amongst ourselves in the U.S. and nobody else is going to touch us. Is that really the case?
In my view, no. It's a global economy, and we are all affected by business cycle forces to different degrees, but I don't think we escape this one.
Right.
I think that monetary policy globally has papered over a lot of the previous weaknesses that we've had, but I believe that it's a global economy, and as I look across and within asset classes, different relationships and economic data, I believe we are all interconnected. But there has been a degree of coordination, if you will, of policy between the major central banks and governments to smooth things over whenever an isolated macro risk pops up, such as Italy.
Yeah. Well, and we've also been, it's quite interesting here. If you look at the United States, I don't want to say it's fortunate because living here in Houston, you and I were both affected by Hurricane Harvey. Mm-hmm. But, in terms of, economic boost, it's very interesting. In 2017, we started seeing a little bit of a slowdown in the economy. And then all of a sudden, we had 3 major hurricanes, 2 major wildfires out in California right around September, October of the year. And that required a boost of stimulus, fiscal stimulus, into the economy. So we had to do rebuilding and repair. And then, of course, subsequent to that, we saw 2 very strong quarters of economic growth in 2018. Saw a lot of hiring in manufacturing, construction, demand for commodities. Oil prices went up because we were using a lot of this stuff to rebuild. And just now, as we're starting to see that begin to fade off, we have 2 more hurricanes this year, major wildfires out in California. Which may give us a little bit of a boost, over the next couple of quarters. But the problem with that is, and to your point earlier, is that we're running $1 trillion deficit in the U.S. at a time when we have economic expansion, which doesn't leave you a lot of powder, so to speak, available dry powder when you actually do get this economic slowdown hitting the U.S. And again, we're having this sugar high of spending that's going on now, but that's all dragging forward future consumption, right? So we're going to wind up potentially in the next couple of quarters or 3 quarters, we're probably going to start seeing the effect of this global slowdown more domestically. Do you think?
Yeah, and we're not going to get the same. We haven't been getting the same boost from a drop in interest rates when stocks go down.
Right.
Yields are staying pat. And you look at our yields relative to the rest of the world, they look quite attractive. You would think all this foreign money would be coming over purchasing our treasuries. But the hedging costs involved with trying to exploit that yield differential is nil. So we're left kind of on our own for right now. And there's more debt coming out. And that puts upward pressure on rates. At the same time, borrowing rates are going up, and it builds a tougher macro picture going forward.
We'll come back more with Kevin Lenox. We're going to wrap this conversation up right after the break. You're listening to the Lance Roberts Show podcast right here at realinvestmentadvice.com. Get by our YouTube channel, The Lance Roberts Show, or on our website at the podcast tab. You can download this podcast and all of our other great interviews directly to your favorite device through your favorite streaming app. It's all at the website now, realinvestmentadvice.com. Just click on the podcast tab, and we'll be right back. More with Kevin Lenox right after this.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertshow.com.